So suppose that in addition to everything before, there's a one-time registration fee of $20 related to creating a user profile to access the multi-user platform. So just an additional layer of charges, right? Where the profile adds no additional service or product by the user for the user. So since it adds no additional services or product for the user, this is not a performance obligation. The treatment then, in this case, is to add to the transaction price of the bundle we're selling. Um, in addition, it says Myrmidon's consoles come with a 2-year manufacturer warranty, and they estimate that the cost of these warranties at 7% of the console's individual manufacturing cost, which is $100 each. So that's the cost of the goods sold, basically, right? This is how much it cost Myrmidon to create a console, and 7% of that is the estimated cost of the manufacturer's warranties. So it's a manufacturer's warranty, which means it is not a service warranty. It is an assurance warranty. So it's merely assurance that the console will meet specifications. It's not going above and beyond. It's not going to cover me spilling water, right, onto the console and it frying the circuitry. That would not be covered under an assurance warranty. That would be a service warranty, right? So we don't have a service warranty. We just, if it comes out of the box broken, we can take it back. That's just a manufacturer's warranty, not a separate performance obligation. All right, so we have really a lot of things in common with the first iteration of this problem. So I'm going to start by making my table again. I'm thinking about the performance obligations. We do have the console. We still have the subscription. The console was 300, still is. The subscription's 100, still is. Do we have any other performance obligations? We said the warranty is not one. It is not a service warranty, so it's not separate. It's just an assurance warranty, so we're not going to include it as a performance obligation. And since that $20 fee adds no additional service or product, we're not going to include it down here. So we still only have two performance obligations to this contract. Well, how are we going to incorporate that $20 fee? We're going to incorporate it when we allocate a transaction price. So the amount of the standalones, what I would purchase each for separately, divided into each individual standalone price gives me the amount to allocate, 75 and 25%. But instead of allocating a transfer price of 340, we're now allocating a transfer price of $360. Because what this represents then is the purchase price for the two in the package plus that registration fee. So we just add it to the transaction price that we are going to allocate to the two performance obligations. When I do the math here, 75% times 360 is $90. And 360 times 25% is going to be, oops, sorry, that's $90. That's $90. The top one is actually $270. Together, they equal 360, which is the transfer price that I needed with that registration fee of 20. And now we multiply this again by the 10,000 sold. which again, these two added up should be the total amount that we're receiving or expect to receive from the sale of this package and the registration fee. So it changes our initial entry a bit because of that $20 registration. We have still a point in time or a point of sale for the console for 2,700,000. And then we have deferred revenue for the remaining amount, 900,000. That's an asset. The sales revenue is income, and that deferred revenue is a liability. All right. Now, that does not take care of the manufacturer's warranty yet. We're going to have to separately, remember, this is an adjusting entry, separately recognize the expense of selling these with the assurance warranty. It was an enticement that after I take it out of the box, it is going to function up to specifications. And that enticement we estimate to be 7%, 100 of $100 times the amount of sales we made. So that's $7, which actually comes out to warranty expense of 70,000 and a payable of 70. And then, of course, the deferred revenue would be recognized in much the same way. It's a 2-year, so this would also be an adjusting entry that we make to the deferred revenue account at the end of the first year. Since this is 2 years, we'd recognize half of it as earned and reduce our liability by half. Like that. Right? So now we're adding that, basically the rest of these notes is going to be adding just little complications, little new features. Is this a performance obligation? Do I have to make another line here? Or do I just need to add it to the transaction price in some way, modify the transaction price in some way? And then again, we return back to the idea of what's going to be recognized as revenue over a period of time, what's going to be recognized as revenue at the point of sale.